time, collapsing institutions, particularly banks, that collapsed with customers' money. And most of the time, you would find that the customers would move from one bank to another, taking loans and leaving a trail of bad debts. And banks, faced with this challenge, would then want to charge high interest rates to compensate for the loans that they could not recover. And that kind of situation, obviously for an economy that is growing, then becomes unsustainable, because then credit access becomes a difficult thing, and only selected people can get to access credit. And even in terms of how the banks grow their businesses, growth then becomes a very slow process. So the credit, to be able to deal with the information asymmetry challenge, and 2007 to allow banks to share information on their customers. This amendment, initially the request was that a bank should be able to share all of the customers' information by which credit reference bureaus would be established in Kenya. So the 2007 amendment to the Banking Act gave birth to the CRB Regulation 2008, which provided the rules and regulations that would guide the operations. Customers would then engage with CRBs. Now, the key highlights in those regulations were that banks would submit all on their customers to the credit reference bureaus, and the credit reference bureaus were then mandated to make sure that they avail customer records to banks whenever the credit history of those customers. It then became an established perception issue that one was in the credit reference bureau because you are a defaulter. So only people or borrowers who had defaulted were sent to the credit reference bureau. The other thing was that the listing in the credit reference bureau was supposed to stay there for 7 years before it is then erased from that particular record. And these two issues became very emotional, because sort of like it also assumed a social dimension. If somebody hears that you are in the credit reference bureau, then they immediately come to the conclusion that you are the type of person who borrows and you don't pay your debts. And therefore, that comes with sort of some negative perception to that. So we moved like that from 2007 up to 2013, when another amendment was passed in the CRB Regulations 2013 to allow banks to share all borrowers' information, whether it was good or it was bad. And this amendment then came with other changes also. It reduced the retention period of credit information on the reference bureau from 7 years to 5 years. And it also allowed other institutions like SACCOs, microfinance institutions, and trade credit suppliers to also join the credit information sharing mechanisms. So the bureau files then started becoming richer with customer information. So many of the SACCOs joined the mechanisms, microfinance institutions joined the mechanisms. Fintechs also got an opportunity to jump into the lending market, because now there was a single point of reference that they could be able of a given customer. And given that credit history, then it was easy now to start extending credit via the mobile platform, because then it was not necessary to have a physical interaction with the customer. So the introduction of credit reference bureaus, obviously what it did was to expand the credit space, reduce the time it takes to process a credit application, and where customers had sufficient information on their credit profile, then the collateral requirements in certain cases got relaxed, particularly when it came to individual borrowers and those who had a good credit history. So I need to state at this particular point that the core value proposition of a credit reference bureau is that it enables a borrower to build a credit history on all of their borrowings, whether they are from banks, from SACCOs, microfinance institutions, or trade credit suppliers. That credit history then creates what you call informational capital, information that tells you the behavior of a borrower when they take loans from the various lenders that I have listed. The Credit Reference Bureau also calculates a credit score from this information that is in the credit, in the borrower's credit profile. And that credit score becomes a measure of the credit worthiness of that particular borrower. So you'll find the scale of the credit score runs from 100 up to 900. Any score that is below 400 would indicate a high risk of default, and scores starting from 500 all the way to 900 increasingly show a customer who has a low risk and who is servicing their debts. This then becomes the value that is derived from credit information that is maintained by the credit reference bureaus. Now, in terms of the use of this information, banks, lenders always reference on the credit reference bureau files to understand the borrower's credit history. And how they use that credit history is simply to understand the behavior. So the credit history or the credit score is a measure of the behavior of a borrower given the credits that they have been taking. It will show all the loans that have been taken, and it will show the servicing trends that exist on those loan products, and it will show the ones that have been closed and the ones that are coming onto the file as new borrowings. There have been also amendments going further as the credit bureau mechanisms got entrenched in the country, and the new regulations that were issued last year in April, the CRB regulations 2020, do now provide that banks should use customers' credit scores to assess customers' credit worthiness when they are seeking for credit from banking institutions. And therefore, in today's borrowing environment, the credit score has become the single most important criteria that any lender will be looking at. So if you see the development, we started from where the Credit Reference Bureau was being looked at as a blacklist. Then we moved from the blacklist to a full credit profile, which now is a record of all borrowings that you have. And we have now moved to say the value of the information that you have on your credit profile is now being turned into a score that now measures your credit worthiness. That score then becomes a very important tool that the lender and the borrower can use to be able to assess the customer's credit requests. And so, in a nutshell, from a borrower's point of view, borrowers should know that what goes into the credit score is all the borrowings that have been reported by all the lenders that they have taken loans from and who report to the Credit Reference Bureau. And therefore, what that means is that the borrower needs to understand the value of that credit score. Now, that credit score, first of all, is a ticket that allows you to access credit, because every lender will look at it. If you have a good score, lenders would want to give you credit anytime you ask. The other value for that score is that in the current environment where you can negotiate for a good interest rate, your score can give you a basis of engaging a lender to negotiate a score, an interest rate that is applicable to you. For example, if your score is 500 and someone else's score is 850, obviously the person who has a score of 850 would get more favorable terms and a lower interest rate because they are deemed to have a low risk of default, as compared to somebody who has a score of 500. It's therefore deemed to be carrying a higher risk, and therefore probably the bank would be, or the lender would be a bit reluctant to say, okay, I will lend to you, but because of the high risk you carry, I'll probably charge you a little bit more higher interest than the market is offering, because I want to do business with you, but the risk you carry is such that I need to protect myself. In other cases where the credit score is low and the lender has a high appetite of giving credit, they may request that you provide additional collateral, like a guarantor, to support your borrowing because of that high perceived risk. But I think that going forward, borrowers must then understand that it is important for you to monitor your credit score and understand what it is communicating to the lender. Banks, on their part, are mandated by central bank to ensure that every time they're looking at your credit application, they must use information available in your credit profile maintained by the Credit Reference Bureau. And therefore, it is not something that it is an option. It is mandatory for them to use that information. And whenever what most banks will do is to take that information and combine it with their internal credit appraisal process and policies to be able to determine who gets a loan and on what terms do they provide that particular loan. I need to finish by saying that the credit reference profile and the credit score are behavioral. They are simply tools that tell a lender how a borrower behaves when they have taken credit. They do not measure the capacity of the lender in terms of the cash flows that the lender has, particularly, the borrower has, particularly when it comes to businesses. Businesses generate revenues from a number of activities, and just focusing on their borrowings in their Credit Reference Bureau would not be able to tell a lender how much credit that particular business should be able to take. And therefore, there is another metric that is required to provide the full answers to what a lender will require. A lender wants to know your character. A lender wants to know what capacity you have in terms of how much credit you can take. A lender wants to know what terms they can give in terms of short-term borrowing or long-term borrowing. Banks these days can give you loans up to 5 years, up to 7 years. Information on the Credit Reference Bureau cannot be able to predict behavior for that length of time. And therefore, a rating then becomes important to now be able to look into the future. Remember, the credit score and the credit history on your profile is about your past. It is showing loans that you have taken and how you have behaved with those loans. To be able to predict how you will behave in future, another metric, which is a rating, is then required to supplement the credit information that is on your profile. And therefore, a rating is then provided. And what that rating then does, it takes into account your credit reference bureau data and other business parameters and combines this into an algorithm that is able to predict the probability that you will service a loan or default on that loan if you are given a loan. And that is now the other metric that we as a company have also come up with. And this is what is then constituted in the credit rating that we are licensed by the Capital Markets Authority. So we assign credit ratings to small businesses, starting all the way from micro, small, medium, and to large corporates. These ratings are useful in predicting future performance of a loan. And therefore, if a lender is using ratings, they have the benefit of knowing your past and also the benefit of being able to predict how you will behave in future when you take these particular loans. In this country today, many businesses are now beginning to embrace ratings. We have been doing ratings on small businesses. Up to now, we have rated over 800 small businesses and a number of large corporates that can use the ratings to go and access credit from the banks. If I have to finish, I want to focus on the MSME, the micro and small enterprise business, and just to understand how can they use the bureau mechanism and the rating mechanism to be able to improve their access to credit and also be able to get favorable terms that lenders can provide. In this country, every time you access credit, that information, if it's from the banks and SACCOs that are participating in the credit reference mechanism, that information will always be in the credit reference bureau. So every time you want to apply for a loan, do understand that lenders will check your credit profile and will also get your credit score. So it's important that as a small business, as a business, you understand what has gone into your credit score, and you need to check that your credit score does reflect the performance of the credit facilities that you have been taking. In terms of empowering you to be able to negotiate terms with lenders, you need to go another step and get a credit rating. For small businesses, it is not expensive to get a credit rating. A credit rating can be obtained for as low a fee as 5,000 shillings, going up to 15,000 shillings, and it is valid for a period of 1 year. And you can use it with any lender, any SACCO, any microfinance, or even a trade credit supplier who is giving you goods or services on credit. To that extent, you can then now take control of managing your borrowing, ensuring that you take credit that is suitable for the purpose for which you want, and don't just take credit for the sake of it. If you are looking for credit for working capital, make sure that you are taking credit that will support you in working capital. If you are taking credit that is to enable you to do a project or purchase an asset, you take credit that has the right terms to fit the purpose for which you want. You will be saved a lot of time in terms of the back and forth, if you go to a lender knowing what is on your credit reference bureau profile and also having a rating in your hands. With these tools now, we can be able to solve the old age MSME conundrum where access to credit has always been a challenge, and that in this market, I think that challenge has now been solved. I can only close by saying that Cooperative Bank is a very proactive bank, and in terms of using information tools that are available to assist them to assess credit facilities from customers, they are very ardent at that, and I'm sure that the partnership that we have with them will benefit you, sure that you are able to access credit quickly and as fast as you can from Cooperative Bank using the tools that Metropole does provide from its Credit Reference Bureau and credit rating services. Thank you very much for listening to me.
Thank you, Bwana MD. Thank you for your time and your words of wisdom, and for demystifying the whole issue around the Credit Reference Bureau. Ladies and gentlemen, that is Mr. Samuel Omukoko, the Managing Director and Founder of Metropole Corporation, and he will be with us to the very end of this session just to respond to the questions during the question and answer session. Please keep them coming, because as we can see on the chat, quite a number of people have joined. So Peter Osiemo says he's joined from Kisii, Galgalo Gilo from Isiolo, Njoki from Narok, Tony Mboyo from Kawangware, Eric Musiemi Muli from Huruma. Quite a number of people have already joined. And an interesting conversation we are seeing on the chat, because quite a number of questions are coming through. Benjamin Kimoi from Ngong, and I think you attended through Ngong branch. Please keep these questions coming. As promised, we will be attending to this during the question and answer session. Thank you, Bwana MD. Please stay on to the very end for the Q&A session. A very warm welcome if you're just joining us. And managing non-performing loans is a very topic of discussion this morning, where we are bringing our thoughts together to see how we need to be leveraging on CRBs to access financing from financial institutions. Remember, to join this conversation, you can leave a comment on the chat box below, or send an email to businessbanking@coopbank.co.ke, or call us on 0711 049 129. Better still, you can call us on 0711 049 08. One more thing I'd want to mention is that today, ladies and gentlemen, is International Youth Day. And what we notice is that as more and more Kenyans venture into business, of course, both young and the middle-aged alike, our next speaker will be guiding us on how we can look at the key elements of loan management for the business banking customer. And to take us through this is none other than Moses Gitau, the head of business banking at Cooperative Bank. And as we engage with Moses, let's see how, in our different capacities as different people in this country, we can leverage on the available options for prosperity. Moses, please feel free to come in to guide us in this very area.
Thank you very much, Patrick, and thank you very much, Sam Omukoko, MD and founder Metropole CRB. And I think before I even go to my presentation, I would want to highlight 2-3 things that I've picked from that presentation, so that even my customers who are the MSMEs and the individual customers who are here, perhaps would also be thinking about. Number one is to say that, and I think Omukoko has clearly said, since we went CRB way, the CRB score, banks have improved on turnaround time. The time you take to get your money, I think there's a lot of improvement. Traditionally, banks used to take too long in terms of a decision of whether you are getting the money or not. I think there is a lot of improvements. The second thing, and I think I'll also be linking to that, is the issue of collateral. I think for those who have been there for some time, will tell you that banks will not give loans without any collateral. So I think Sam has said, which is what then I'll also be talking about. Banks now can even give money without necessarily having a title, without necessarily having a security. And I think the third thing that I would also want to highlight from Sam's discussion is that the amendments he has talked of in the CRB amendments that were done in 2020. How does a customer assess the credit to others? How the score enables you to determine the creditworthiness of the customer as an institution? I think he has talked of that, and I think that comes with both the positive and the negative listing. So even the information, the positive listing. So let's not only look at CRB as a negative tool, but it's a very positive. The positive information that comes there helps us in terms of the bank determining, or the renter, let me use the word renter determine the creditworthiness of the customer. I think the last one is the issue of to say CRB score is behavioral. So the bank then will go to the other, or the renter will then have the other parameters, look at the other parameters to determine whether you qualify for the facility. So I think those 4 points came out prominently in the discussion by Sam, and I needed to highlight for my customers. So straight now then to my presentation, and how now Cooperative Bank, or as a lender, then we link you to this discussion. Just stay to that on that side. What are the available solutions for business customers? And I think there are basically two needs that a business customer has. Number one, it's what we call working capital, and working capital is what is a short-term facilitation into the business operations, the day-to-day business operations. This will be either you are purchasing stocks, you are paying salaries, you are paying maybe you are acquiring space, you are paying for rent, all those small operational issues that will run into the business. I think helps you in terms of working capital, and that's why Sam was talking of the short-term facilities that you acquire from an institution. The second thing that comes in for a business customer, the second need is what we call investment capital. Investment capital is short of a bit long-term. It's long-term, and this will go to things like purchase of land, purchase of property, purchase of equipment, and even motor vehicle, things like construction. Those are what we call investment capital. So that is the second need, is either working capital or investment capital. I think let's go to the next slide, Patrick. The next one is, what are the key considerations? What do we consider as an institution, as a lender? What would a normal lender, any other lender look for in terms of assessing your request? We look at the market, the location, the traffic flow. We look at competition. We also look at the demand, and of course the risk assessment. And CRB has come in handy to help us in terms of assessing the risk. So part of the consideration will be also your score, and that's what Sam was telling us. We'll be looking at, for a business customer, we'll be looking at how long have you been in the business? How long have you done that business? We'll be looking at the legalities. Is the business you are in, is it a legal business? Because as an institution, then we have the obligation to support the legal activities for the country. Does the business have cash flows? And I think Sam has mentioned about cash flows. Critical to say, does the business has cash flows? Because the repayments that are expected will only come from where? From the cash flows. Where is the borrower banking? I think a very key consideration to say, any lender will look at the bankings that you are doing with them, and anywhere else that you are doing the bankings. And then, are you licensed? If you are operating within a certain county, are you licensed by the county? Are you licensed by the bodies that license the businesses? I think then we'll be looking at the licensing aspect of it. We will also be looking at the business type, because it could be a sole proprietor. We rent to a sole proprietor. I think the rendering is different from when it's a partnership, from when it's also a limited company. So we look at the type of business. How have you been registered as a business? The other thing is the management. And I think this comes in terms of the skills, the experience that you run that business. That is very key. And Sam has raised a very important point to say, there are those 5 C's that we consider. And the 5 C's, just to bring it out, the 5 C's consist of character, which is the character of the borrower, and to a large extent, the CRB score will show that. Some historical whatever will show that, data will show that. The second C is capacity, and capacity shows the ability of the business to generate cash flows, the ability to repay. The third C is on capital. What is your contribution into that business as a borrower? What is your contribution into that business? The fourth C is on collateral. And collateral, we mean you are looking for security, because as I said, we have cases where somebody can qualify for unsecured, but you also have cases where somebody is required to provide a collateral. So collateral comes in as the fourth C is collateral, which is also security. And the fifth C is conditions. That and conditions comes in when there is that agreement between the borrower and the borrower and the lender to say, I'll lend to you money once you meet this condition A, B, C, D. And those conditions then you have to meet as a borrower for the lender to extend the facility to you. So the 5 C's then is character, capacity, capital, collateral, and conditions. I think those are very key in terms of now determining whether the lender will be able to lend the money to you. And maybe for business customers, you need to note those 5 C's. The next point is to say, what are those basic requirements? What are those basic requirements that you'll be looking for? They are very basic. Is a bank operational account. The existing business, I think I've mentioned about that. The documentation and records, because the banker will want to see some records. If you are in a business that is trading and you have sales records, the banker would want to see your sales records. The banker would want to see your bank statements. The lender would want to see the license. So there's documentation and records. Of course, there will be the payment history that comes through now the CLB, and Sam has talked of that history, the score that gives you the historical behavior of the customer. And that goes without saying, the acceptable CRB score. And I think Sam has talked of that. And we're not saying if you are below 400, we are not saying as a bank will not lend to you. We'll still lend to you, but we have to mitigate to say that the person below that score of, I think he gave a score of about 400. Below that score, they are still acceptable. We still lend to you, even the score is 100, but we would want to have to mitigate that to say this customer, this business have shown some tendency of risk. How then do we mitigate? And that's where the conditions come in to say, what conditions then can we put for between the lender and the borrower to ensure that the bank's money, that money is paid back. And then I think the last key thing is the security, and that comes in where it's necessary. We are saying security where it's necessary, because some facilities then would have unsecured status. I think being now going to specific business customers and addressing that question of the time taken to money, we are saying as a bank, we have gone even digital, and CRB has come in handy to help us and say this customer can borrow on phone. This is let's say that is money on the phone. This is in less than a minute, you are able to access funding up to 1 million shillings. And that is the benefit of now the CRB score that Sam talked of. We'll go through that score, and once you meet the criteria, within less than a minute, you have the money on phone. That is up to 1 million shillings based on the CRB score. So what do you need to ensure that you qualify for 1 million or even a higher limit? Is basically the cash flows have to come to cooperative bank. You need to have a business current account, what we call the MSME package, and that account need to have the cash flows coming in. Then the favorable score, just I quote Sam has talked of, and again you also need to be operating the phone banking, COP online, and the MCOP cash for cooperative bank for you to access that money. So that is one of the biggest benefits that CRB has brought in to customers, in that you can access your money in less than a minute from institutions and from several other institutions, but specifically from Co-opBank. We are saying for the business customer, you can access 1 million on phone in less than a minute. As far as your score is good, and we are saying for this facility, it runs concurrently with other working capital needs. It can run concurrently with a mortgage. It can run concurrently with an asset finance. And how do we treat this? It looks like sort of an emergency. To say this facility is available 24/7. As a business person, we require money very early in the morning or late in the night, where the bank, where you cannot physically visit a bank. I think what we are saying with that, you can be able to access your money even up to 1 million, depending on your score, the score of your account. And I think that is now the key benefit that credit reference bureaus are brought into the lending market. I think the other thing as we go to the next slide is to say we have several other solutions. We have even unsecured facilities that come in based on the cash flow. So 1 million is not the max. The maximum that you can borrow as unsecured, although this one now will not come on phone, from Cooperative Bank, if you're operating an MSME gold package account, you can borrow up to 10 million unsecured. It ranges between 600, 1 million to 10 million unsecured. That means you do not have to have any collateral. The only thing that you need to have with us is an operational account, your cash flows, and all the banking coming to Cooperative Bank. The other facilities that we offer is the asset finance, and this we are saying is a form of financing extended to acquire or use an asset. And we use that asset as a security, meaning if you are to buy a motor vehicle, we use that motor vehicle as security. We do not have to ask for another security. And I think with that, then there are those other requirements that come in terms of borrowing an asset finance. The next slide is on, Patrick, if you could move on, is on mortgage facilities. And here you are saying, and I think I talked of earlier, the investment capital, you can buy a house and then as an end buyer for in terms of mortgage financing. A ready house that you can go in and buy. I think as a bank, then we'll rent to you. We can do construction financing as a bank. I think as a second one, to say you have a property and you want to do construction, and this could either be your home or rental, residential rentals, or even office rentals. I think those ones we are saying we can do construction financing. The third area that we cover under mortgage financing is also what we call equity release. And equity release means you have maybe drawn money out of your business and bought a property. You have drawn money out of your business and you did construction. So by equity release, you are saying we can now finance you that money back to the business. Then we have RADOT financing, and this is specific to now the landlords, people who are in whose day-to-day business is on provision of housing, the people we call the landlords. Into the next discussion is the financing. What do you require for a mortgage? I think I would go through that because basically you have to submit an application, but I wouldn't want to go to all those details that you have captured there. It's just to say that you have to submit an application to the bank for appraisal, and there will be several needs several stages that you undergo in terms of now determining at the end of the day whether you qualify or not. I think I wouldn't want to go to all those details of that. But I think linking now my discussion to what Sam talked of is how do you maintain a high credit score? And Sam talked of a credit score, the highest being 900. How do you maintain a high credit score as a business customer? I think this is very important to say. As a customer, when you are applying, their own purpose needs to come out very clear. Identify and quantify them to help you as a need the much I need and it's to my capacity. So that good helps you in terms of improving the credit score. So the better you pay, the higher the score that the higher the CRB score that you get. So your repayment history then comes in handy to say this has been a good payer, the higher the score. The second thing is to ensure that you as you negotiate your terms with the bank, that you get the best credit structure. And by credit structure, we are saying you need to match the needs with the credit facility type. And this is what is to say, if you are then looking for working capital, you have to go for a short-term facility. If you are looking for investment capital, then you have to talk to your bank to ensure that you get a long-term facility, and be open to the bank, be open to the relationship manager to say, this is exactly what I want to do, so that at the end of the day, that matches the need matches with the facility that the banker will offer to you. And on several occasions, we've seen customers, especially the the MSME customers coming in for a short-term facility to go put up a house. At the end of the day, that gives you a mismatch in the facility, and that mismatch then comes into you come into struggle, and it will affect the score that you get. I think that is very key in terms of determining then how do I improve my score. Number one is a credit structure and a clear identification of the amount required and the needs, so that you find a specific need without a diversion or those other things, to ensure that you improve on your credit score. The second thing is on how then you manage your loan management, what we call the loan management. And under loan management, as you engage with the banker, I think it will be very critical that you get to understand what we call a repayment schedule. And a repayment schedule gives you the specific days that you are supposed to pay. As an example, to say, if you agree with the banker that you are supposed to pay on 5th of every month, it means that date is what you need to honor, the 5th day of the month. Anything going beyond that, maybe you go to the 6th to the 7th, it starts manifesting some struggle on the customer. So ensure you stick to what you call now the repayment schedule, and that mark it somewhere to say, I'm supposed to pay on 5th. By 5th, my money should be there to enable me pay the loan. I think it helps you in terms of improving. So that timely repayment helps you in terms of improving the credit score. The issue of sales collection solutions, and this comes in handy to say what comes into your account as a customer. So it's not to say that once I borrow a facility, I'm supposed to pay on 5th, I'll only bring the money on 4th to the bank. The more you utilize that account, the more it makes you, it improves on your credit score from the bank. So to ensure that you bring all the turnovers, at the end of the day, the bank will only recover the agreed installment. If it's agreed, we agreed to recover 50,000 on 5th, that is what we recover. But you can bring you need to bring in all the sales and ensure that you have what we call a collection solution from the bank. If it's issues, if you are collecting through maybe Lipa na M-Pesa, we have a facility to terminate that money into your bank account. It helps improve your score. The turnovers that come into the account, the bankings that come into your accounts helps improve the score. Channel all sales proceeds to your bank account. I think that is also very critical to ensure that anything that you sell, all the sales that come in, if I funded you under working capital, I would want to see all that money coming in. And then for you is to move that money. I know you have obligations to pay, maybe your suppliers, you have obligation to pay salaries, you have obligation to continue buying stocks. That money should come in, then you buy your stocks, or you meet your other obligations. I think the other critical thing that would help you in terms of improving the credit score is avoid diversion of funds. And diversion of funds, what I mean is to say you have taken working capital, you have come to borrow to go increase your stocks as a business customer, and then you go buy a plot, you go buy a car, you go buy improve on your house, or that money goes again to personal consumption. Avoid that diversion. So it's very critical as you borrow, you know very well this money needs to, wherever it's going, that's where I take it. It will help you, because at the end of the day, if you start, it will mean you struggle in terms of the payment, and that helps you now again improve the credit score. The other thing that comes in, and this is very important, is where you see that your business is manifesting some signs of distress, which is given. Most maybe there are seasons that the business is not doing well. Most like now the COVID period that you are in, what comes in to enable you meet the installment on the specific date is that you can have an arrangement with your bank to build your cash. Your cash build-ups, and that is to the extent of the installments. So meaning, if I'm paying maybe 60,000 a month, it means maybe it's how much? It's 2,000 a day. Can I have that habit of building that installment, that 2,000 on a day, so that on daily basis, so that by the 30th day, I'm able to meet my 60,000 repayment. So cash builders helps you in terms of avoiding the last minute rush to say I'm looking for 60,000 and it must be 60,000, but that build up helps you in terms of enabling you meet the installment, and it comes in handy in terms of improving your score. You can open a separate account, a savings account, that will help you in terms of repayment as you operate the other business accounts. I think the other thing that also helps you in terms of improving the score is keeping your relationship manager or your branch manager on any developments that happen in your business. For example, as we say, maybe under this COVID period, your business is experiencing low sales. Maybe you have increased orders or you have some trends that are emerging. Keep your manager, your relationship manager or your business banker, the branch manager informed, because at the end of the day, they will have to have an explanation to say, so and so is not meeting their installment because they had expressed, they had indicated that their sales are low. And this helps you now in terms of now agreeing with the manager or the business banker. How then do I tackle my issues if I'm struggling to repay? Avoid over, and as a that point is avoid over borrowing and multiple borrowings from various financial institutions. This comes in to say, if you overborrow, if you overcommit yourself as a business, at the end of the day, a ball will drop somewhere. So let's avoid that portion of borrowing, avoid that of borrowing and multi-borrowing from several institutions. The other part in terms is the loan arrears management, which is very critical. And I think what you are saying, we appreciate, and every business person would appreciate that some businesses will have a low and high. And at one time, maybe you go into arrears. At one time, you see I'm struggling in terms of payments. And what you are saying is rush with the manager in exploring some